Hey everybody, Wes Aranto here, Chapter 10, Fundamentals of Investing. Let's talk a little bit about it this week, and then anything that's missed I will catch up in week 9, but let's take a look and try this out here. So first of all, I hope everyone enjoyed their reading week. We are talking about this being week 8. Please do the discussion board as well as check out on everything else, and you will want to watch this video before you do the discussion board. So here are some of the learning objectives we're going to be covering. Explain why you should establish an investment program. Well, I think that's pretty obvious. We want to build some money. You want to build for your retirement. You want to have stability. And everyone, of course, in the class remembers my definition of retirement, which is choice, the ability to choose. We all remember that. Talk about different safety risks. This is basically an introduction into investing, a bunch of different major investment alternatives that exist. And then, well, financial planner, do you want one, don't you? That is a very individualistic decision, and we'll talk about that. Other sources of information, we'll talk about that as well, but the other topics are a little bit more of a key focus. So, investment goals. What are your investment goals? All right, everyone's are different, okay? First of all, why are you investing? Are you investing for the future? I hope most of you fundamentally are. But the truth is, in the short term, when you're young, maybe you're doing some of your investing for the purpose of building capital to take on bigger projects or do more like that. That'd be great as well. Investing can be in many different forms. You can invest in yourself. You can invest in business. You can invest in stocks. You can invest in bonds. You can invest in real estate. There's so many different and so many more alternatives out there. So the question is, where are you most comfortable and why? Part of the answer is what makes you comfortable. You really should do a self-assessment of how much risk you're willing to take and why you want to take those risks, because everyone's a bit different. When I was younger, I'd take more risks than I will now. That's a little bit inherent. I've now earned and created some wealth, and so I'm a little bit more concerned and wanting to make sure I protect it. I don't view that as a negative, but that is factual and something I am worried about. So I want to make sure I do protect that. At the same time, I still want to grow my wealth. So I take certain risks, and certain risk is worth taking. But how you research that and do things would be up to you. The financial checkup, we'll talk more about that in the next week, so I'm not going to spend too much time on that. Big thing is that we've talked about the cash reserves and saving up money and stuff like that. So I think you have a good idea of what I view that as. And then for you, all right, cash advance on credit card, remember that's a dangerous one. We're going to try to avoid that one at all risk if we can. Insurance protection, I've already talked a fair amount the last couple of weeks about insurance, so hopefully you understand the value of that, as well as how insurance can also be a different form of investment vehicle when you're talking about permanent life and critical illness, and the two options inside the permanent versus term concept that we discussed last week. Well, meaning last week of class. So how do you get started? It's really simple. Start. And I know that sounds ridiculous, but what that means is take some money, put it aside, and have a purpose for it. All right. I personally don't care how you invest. What I do care is that you invest in what you believe in and what you believe will make you either good money or the type of investment you want. So for example, let's say you've got $1,000. I want to start investing, but I don't want to be directly involved, or I don't want too much direct involvement. Then okay, maybe you get into the stocks, or you get into hiring a advisor and have them invest it for you. I'm good with whatever. On the other side, maybe you want to be more involved. Maybe you're like, okay, first I want to flip products, or I want to do other things like that, something a bit more risky but also greater upside potential. Do that. One thing I will be cautious, especially when talking about investing, is that there's an old saying. One is that if the old saying was, if your shoe shine guy is starting to give you stock advice, watch out. What that basically, the concept behind that was that once everyone's giving you advice and everyone's got an opinion on it, it means most things are overinflated. All right, so it means that be cautious there. The truth is, there's experts in the field, and if you start listening to your neighbor because they have a great idea, unless you know their qualifications or their awareness or their motives, you want to be very careful with that. You want to invest in things you believe in and things that you understand. I am a firm believer, don't invest in something that you couldn't explain to somebody else or that you can't explain to yourself. If you're like, oh, that sounds really cool, but I don't understand it. In general, I'm a type that would say, okay, either learn more about it till you do or don't invest in it. Okay, because whenever you can't say you understand it, you take a greater risk that maybe it's a bad investment or one that if it's so complicated you can't understand it, there's too much risk and they're trying to hide something. So just keep that in mind for yourself. Make decisions you're comfortable with. So obviously at the beginning you're trying to save some money, get some money built up. Take advantage. So like I said, remember when you get inheritance or gifts, most people go out and spend it. Be that other person. Go out, put a big chunk of it into savings and invest it. Utilize it for your future so that hopefully you can find a day in the near future where you don't have to work as much or you get to choose what you do or don't work at all. All right. I think I've reinforced that week after week. So time value of money. Keep in mind this concept is very simple to high level. The earlier you invest money, you get to reinvest it and the interest becomes interest upon interest. That's called the compounding effect. That's the time value of money. So that's why the longer and earlier you start investing, usually the better financially off you are, is because that helps get you on that kickstart of actually making money on money you didn't actually earn. And so if you think about it, you know, let's say you have $1. Let's pick it easier. Let's say you have $1,000, 10%, you make an extra $100. Next year, you have $1,100 and you get 10%. Now instead of making just the 100 on your 1,000, you're also making an extra $10 on that $100 in interest that you'd already made. So now you're making money on money you didn't actually invest. That's what is the great value of time value of money, and that's also what creates that multiplier effect or that exponential effects of why time investment makes such a big difference. So make sure you invest earlier if you can, and front load it a bit even for yourself, meaning putting in as much as you can at first, even if it makes things a little uncomfortable for you, because long term that'll lead to much greater success and financial enjoyment for you. So here's a chart of how that type of concept works. $4,000 with different rates of return. So for example, you'll see on the green there, you've got 8 years and at 8% at 20 years, what that money would look like. So what you'll notice is at 8%, when you get to 40 years, you're at $1,036,000. Okay, $1,036,226, I think it is. The reason that grows so much is that now interest upon interest upon interest occurs, hence that compounding effect and time value of money. That's why time is so important. So if you think about it, 3 years from now, let's say you're 25, just picking, you start putting this 4,000 in a year, the stock market averages at least 8% a year, you know, okay, now you're talking, if you kept putting in 4,000 a year every year for 40 years, at the end of 40 years, you're going to be a millionaire. That's not bad for a backup plan, for a savings plan. You know, you just have to stay diligent with it and have to do it. And if you get to a year where you do better and you get to put in 8, that means the numbers are only going to be better. But it also offset those years, maybe you can only put 2 in. So my point is the earlier you start, the better. Can't overemphasize that. Please keep that in mind. So some of you, on the other hand, may be afraid of risk. So keep in mind, if I was talking like 8%, that's putting it in mutual funds and stock markets and taking some risk. Some people, if that's going to keep you up at night, don't do it. Okay, please just invest in a method that you're comfortable with and use that time to grow it. Even if it doesn't grow as big, it'll still grow substantial and can make a meaningful difference in your life and in your ability to retire. So just remember, don't quit on it. Keep working towards that final goal. Different types of investments. These are super safe ones. Some of them, like treasury bills, don't really exist anymore. They do exist, but they're not really utilized. So I'm going to GICs, savings accounts for the first time in many years because of our inflation / our interest rate is finally actually earning you some money. If you go back to 2019, 2020, savings accounts were bringing you 0 to 0.05% interest a year, which is basically nothing. So basically, that's only changed because of inflation. But do keep in mind those account amounts that you raise never are equal or greater than inflation, or almost never. So that is not a way to get wealthy. That is just simply a way to not erode what you have. So do keep that in mind as well, please. Speculative risk. Now you have to understand it. The definition that occurs here, high risk for some may be viewed as low risk for others. So investing in stocks is inherently high risk. Investing in real estate and collectibles is inherently high risk. But if you're educated in the topic and you understand it, for example, as a realtor and as someone who has a bunch of investment properties, I don't view it as a high risk. There's obviously a risk associated, but I'm not afraid of it. So mutual funds, even things like that, are viewed as high risk or speculative risk. Like I said, keep in mind that your skill set will help dictate that. And the truth is that in the short term, everything from my viewpoint can be high risk. Long term, less so if you're well diversified. But that's a personal opinion. I'm not trying to force anyone into that. And do want to just keep in mind that there's always more ways to view it. So different types of components of risk. So we've business failure risk. So obviously we've had numerous of those. Things like BlackBerry, where they were a huge cell phone provider, and now no one has a BlackBerry in North America. Stuff like that. Things that can occur to eliminate your industry, that does exist out there, whether we like it or not. And so some of those exist. Amazon, for example, has impacted many other retail outlets online and put them bankrupt. So, I mean, things like that. Inflation, we're living inflation risk right now. I mean, inflation risk is at the highest it's been. It's why interest rates are going up. They're trying to slow down our inflation, and that can affect our GDP, which affects our growth rate. Sorry, hiccup. And inflation and interest rate risk are usually heavily tied. And then that can affect things like the markets. So, for example, if people have less money to spend, they're less likely to go out and buy products, which can then affect retail sales or car sales, other things like that. So the point is, one market may get hurt, another market may benefit, but in the end of the day, the total spent may go down. Okay. And then global aspects. I mean, the war in Ukraine as a simple example, hugely impactful potentially on supply chain challenges and stuff like that. So the way we get products and manufacturing components for products. So things like that can obviously have a huge impact that we also are far outside our control. So I'm going to deal a lot next week when talking about investments. I will open up one of my personal investment portfolio books to show everybody how it looks and what it looks like, and different types of investments and the results and how you measure them. My real estate stuff, I can explain that as well in the sense of how I measure the success of an investment in real estate, everything from quality of tenant to my cap rate, meaning the return on the investment, to the ability to pay it down, to my cash flow, and talk about all those types of things. So we'll use some of those real life examples next week. So investment growth. So keep in mind stocks and stuff like that grow over time. Mathematically, if you look at the history, we've been quite successful on everything from real estate to the stock market, that if you invest long term, a lot of those short-term risks disappear, but you have to be able to survive through those short-term risks to make those happen. And I can show you a lot of charts to support that. And that's no different now. You go into a recession, everyone's upset, people are losing money, and they are. But those that are able to weather the storm often can come out better as well. So the thing is that it really depends how you view it, but this is part of the reason why, for example, a senior shouldn't be in high-risk portfolios and stuff when they're approaching retirement and planning to start drawing from that portfolio, because the truth is you can't control it in the short term. So if you lose 40% of your value and you still need to draw the money, that'll be money you never can recover on. But the truth is those people should be in more safe investments so that risk doesn't exist, so that they don't have those big negative swings like maybe someone in their 20s can handle because they don't plan to touch the money for 40 years. So there we go. Stock and equity financing. So keep in mind, equity is the purchasing of the ownership of a company. So when you buy a stock in Amazon, technically you're an owner. You may not have a practical say, but you are an owner. Where on the other side, you can buy the bonds of a company, which means you hold their debt and you're the lender against that company. So when we're talking about stocks and equities, we're talking about ownership and that side versus bonds, which we're talking about the liability side, where you're an owner of their financing. So, for example, most companies, let's pick CIBC, big Canadian bank, RBC, doesn't matter. They have a profit line that's almost always in the black, meaning they've always made profit, and then they give out a dividend. So for example, all my bank stocks, every quarter I get some money back for every share I have, because that's the money they put in. So, the money they put out to the customer to keep you enticed. Some companies, keep in mind though, if they give you out the money, then they won't grow as much. All right. But so for example, bank stocks as an example are more stable stocks, so they often pay greater dividends because for them, they want to grow steady. At the same time, they want to keep rewarding you with dividends. On the other side, you would have companies like Amazon who pay almost no to zero dividends, but their growth is much bigger. All right. And that's how Amazon has grown to the type of numbers it has, is they weren't giving out dividends. They were reinvesting that money to make themselves bigger. And if you look at, I think most of us can recognize that North America, especially, Amazon is the powerhouse for delivery of products online. So remember when I said you can also buy the debts of a company, that's the bond side. That's where now you are basically the mortgage holder of a company. That's the other side of the coin. So on one side you got equity, on the other side you have bonds. So you're either an owner or you're the financer. Mutual funds, keep in mind that's a collection or a pooling of a bunch of stocks and bonds and other things potentially to help reduce risk when you don't have a lot of money. So for example, let's say you like technology. Then you can buy tech-related mutual funds, which have a gamut of all or a bunch of different tech companies to diversify your risk, but still focus on industry you're interested. Or you can buy an index fund, which is a mutual fund based on the index or the overall stock market, where then you're diversifying across hundreds of companies that way to help reduce risk. And then you can do that in different countries and stuff like that to reduce the risk even more. We don't deal a ton in segregated funds, but we can talk about that at another date. And then real estate, obviously I've covered real estate. This is a part I'm happy to do next week and talk a bit more in detail live, just because it's such a big animal, and I'm happy to. Some of these topics are ones I find get a ton of questions, and of course it's one I'm more skilled in, so I'm happy to answer them as well. So let's leave some of those to the next week, and I will expand on that for you in greater detail. A different way to invest in real estate is called a REIT. Basically what you're doing is treating so basically as a bigger company, they buy a whack of properties. You have no direct involvement, and you're basically funding their ability to buy these properties and maintain them, and then you get a portion of the profits. So REITs are more common or more interested for people who don't want to directly own their own properties but want to invest in real estate, this is a good method to do that for some, and the payouts can be quite good for some people. So REITs can be another effective investment tool, and it's one that you can do in more the stock side versus actually owning the asset yourself directly. This we're going to leave for another day. Scrutinizing debt instruments, that's a big project, and one most of you probably in practical life won't need to do or won't have the need to talk about. So I'm going to leave that one just for now because it's a pretty high level topic. Alternative investments. So inside the stock market, for example, looking at puts and calls, you can bet on whether you think a stock's going to go up or down. Some people view it as gambling, others view it as smart economic decisions. Derivatives, so basically what it is that calls, or if you believe the company is going to go up in value, you can buy the right to purchase the company at roughly today's price in a certain time period so that you can make money. Or put is, okay, I believe the stock's going to go way down, so you buy it, you get the right to buy it at the lower price, even though you're sort of fixed at today's price. So I can give you examples of how those work, but those will be a little bit, again, easier live. But basically the idea is you're buying the option to purchase or sell a stock based on a certain price, and there's a cost to doing that. But if you're right, then you can make money on something technically you didn't really own, but you just flip the right to it, which I can describe more in detail. May seem a little high level right now. Derivatives, commodities. So commodities is, your main staples. Those are things I will cover a fair amount next week. Hedge funds we don't talk too much about. We'll touch base with them, but they are a bigger financial thing that is meant a little bit more targeted towards sophisticated investors. And I wouldn't say that's the target of this class, but those that have questions, I'm happy to answer. And then stuff like precious metals, coins, collectibles. We've already talked a fair amount in class about those items and how they can either be valuable or personally valuable, one of the two. All right, so this is a good overview slide. It talks about common stocks. So just to be clear, most of the stocks you buy will be common stock. Preferred is a more targeted one, either based to an employee or a very unique situation. But as a normal purchaser, when you go out and you buy a stock, it's going to be a common stock, just so you know. And then we got corporate bonds, which have higher yields but higher risk. Which means you're buying the debt of a company like Amazon, CIBC, or even much higher risk ones like mining companies. Government bonds are usually safer, but keep in mind I'm referring to main G7 or G20 type countries. There are countries out there that have very high risk. You got real estate, which is more in the middle ground. And then derivatives and commodities, stuff like that, the risk is always very high. And same with precious metals. But we'll talk about them. And the thing is, diversifying into them is always can be a good decision. But it's one probably most people won't start in. So yeah, when looking at making your investment choices, my biggest one over even diversification, I mean, it's what every advisor will talk to you about, is the fact that you also need to invest in what you believe in or what's important to you or what you think is the future. Investing just randomly makes less sense to me. Invest in things that you're like, okay, I believe this. Like, okay, Tesla, I believe Elon Musk is awesome. Fine, invest in his stuff. If you don't have the time, don't want to research, then do more the mutual fund side where you diversify, in my opinion, because diversification can be very valuable in that type of scenario. And then it talks about different, the high risk, the pyramid aspects. So first you're working towards financial security, then safety and income, then growth, and then speculation. Now that's great, but I got to be honest, that pyramid sometimes gets flipped a little because the truth is when you're 20, it's okay to invest a bit higher in speculation than it would be in your 50s when you have more money. So it's not a perfect system. It's just meant to be a guideline and stuff like that. And I will say, actually, I would argue top down more than the other way. Start with some speculative, then your growth, then get into safety. So I'd actually view this a bit in a reverse system versus level 1 to 4. I'd almost view it the other way. So, like we've talked about numerous times, investment goals, setting your goals, dealing with SMART, specific, measurable, attainable, realistic, and time-bound. The amount of money you'd need to obtain your goal, that's a tough one because you're estimating everything, including interest rates, including the future. But the truth is you need to set a goal. You know, I feel I need $3 million to retire. Okay, set a goal. Now, in here, we do have a good article about it. Is $1.7 million enough to retire and not really erode your basis? So please review and watch that article. That would be great. And then we talk about risk factors, or you need to look at different risk factors. Choosing multiple investment vehicles is a smart decision. You take more risk when you only stay in the one. So even as a realtor, even though it's the one I know better, I still put money in stocks and bonds, and I do spread out, even though a majority of my value is still in real estate. And then constantly evaluate and update is just a good plan, regardless of how you're building your goals or your business plan. You always want to constantly be evaluating and adjusting. All right, so we've talked pretty good about investment alternatives. Financial planner. So half of my investments when it comes to the stocks are my own, half are through investors like financial planners, advisors, or insurance advisors, where I'm utilizing some of those things we talked about last week in the permanent insurance. So they all have a place. What the right one for you is can be complicated, or what type of risks you're going to take. But what I will say, the key, like I mentioned last week in class, was that advisor, you need to trust them. You want someone that actually, knows their stuff. So most of us want to support our friend, but make sure that especially if that friend's young and new to the industry, that they have a good mentor who's very skilled, because you don't want to risk your future just to support a friend. You want to support that friend while they help you grow and be more successful. It's more of a team effort. So just make sure they're not too willy-nilly, because unfortunately I have seen people change their industries frequently, especially at the younger years. And it's frustrating as an investor to lose your advisor and they move to something else. That can be very irritating at times. So, there's different incentives and other ways to reduce risk, but we're going to leave off tax calculations and stuff like that. Please just understand that dividends pay out at a better rate than your income will in general, and that you do want to utilize the vehicles that exist, such as TFSAs and RSPs, before you invest outside them in general, just because you're saving money, or in RESPs for registered education savings plans, before you invest outside them. So outside that, don't worry too much about this slide. And this one. So investment sources, the biggest one, to be 100% honest, is online development and your own personal research. There's a lot of research, a lot of stuff out there. And then also what you truly believe, because at the end of the day, a lot of people made good money on picking Elon or picking on Amazon because they believed in Bezos. You can make good money doing it that way, but at the same time you have risk. Okay, there's some really smart people out there that can totally fall behind, and then next thing you know, the company's gone. So for example, most of you use Adobe Acrobat. Just there was a primary competitor called Corel. Most of you haven't heard of Corel, and I don't blame you for that, but they were the main competitor to Adobe when it came to Illustrator and Photoshop, and they were the number 2 in the industry, and they really fell off. Adobe sort of took that premium suite market of photo editing and stuff like that and ran with it and succeeded. So, but both sides had great pitches and great concepts to why they would succeed. So just make sure you don't get too caught up in the glitz and the glamour either. Some good art. Money Sense is great. There's many great places out there to research. Investopia. A lot of the banking facilities now have very good investment apps. You should take a look at them. Do some research. I'm not trying to push one over the other, but there's a lot of information out there. It's more about making sure you're not getting scammed. Be very careful. TikTok, Facebook, ads at the top of Google and Bing, because a lot of those can be false in the sense that they don't do any verification checks. So you just want to be careful. Like I saw lots out there about Ryan Reynolds saying you should invest in this. Those were all scams. Those were all made up. That was not Ryan Reynolds. Ryan Reynolds has not supported those things. And so you just want to be very careful that you actually do real research and go to the source and verify this information. And then other things like, well, digital newspapers, periodicals are good, but that's a little bit more for the past. In the truth, you want to see the future. McKinley is a good one. Money Sense. There's lots of great ones out there. But you can even Google that, to be honest. And the truth is, nowadays, you can also get an investment bot. So AI has allowed it so that now you can invest with an AI bot. It'll go up and trade in stocks based on an algorithm that it's built that it'll adapt and increase or arguably get better. And so there's lots of different ways out there to invest, whether it's yourself or through an AI bot or through a personal advisor. So I think at a high level we covered all these things. What I am going to say